If you work in a public tech or biotech company in San Diego, there's a good chance you have an employee stock purchase plan sitting in your benefits portal that you never enrolled in, or that you enrolled in once and never thought about again. That's not unusual. Industry survey data puts median ESPP participation around 38%, which means most eligible employees aren't in the plan. In this video, I'm going to walk you through how these plans actually work, the two features that determine whether yours is worth using, the tax rules that trip people up, and the risks that nobody puts in the enrollment email. I'm Brad Stevens with BAS Financial here in San Diego. This is educational material, not advice about your specific situation. So let's get into it. Let's start with the basic mechanics, because a surprising number of people enroll in their company's ESPP without ever getting a straight answer on what it actually is. An ESPP, or Employee Stock Purchase Plan, is not a grant. Nobody's handing you shares. You're buying them using your own money through payroll deductions that come out of your paycheck over what's called an offering period, usually 6 months. At the end of that period, whatever you've accumulated gets used to purchase company stock at a set purchase price. That's the whole mechanism. You elect a percentage of your paycheck, it gets set aside, and on the purchase date, it converts into shares. That's very different from an RSU, where the company is giving you stock outright as compensation, and it's different from a stock option, where you're being granted the right to buy at a fixed price sometime in the future. With an ESPP, you're a buyer in real time using payroll deductions. Now there's two flavors. A Section 423 qualified ESPP is built to meet a specific set of IRS requirements. And in exchange, it unlocks favorable tax treatment if you hold the shares long enough, which we'll get to in Section 4. A non-qualified ESPP doesn't meet those requirements. It's more flexible for the company to design, but every dollar of the purchase discount gets taxed as ordinary income the moment you buy, with no path to better tax treatment. Most large public companies run qualified plans, but you shouldn't assume that. It's worth confirming which one you actually have. The reason this matters up front, everything else in this video, the discount, the look back period, the tax treatment, only makes sense once you understand that you're the one buying the stock on a schedule your plan document sets with money that you otherwise would have had hit your bank account. Once you know you're buying, the next question is, buying at what price and on what terms? Two plan design features answer that, and together they determine how good your specific ESPP actually is. The first is the discount. Most qualified plans let you buy stock below its market price, and the maximum allowed under a Section 423 plan is 15%. According to a 2023 survey from NASPP and Deloitte, 85% of qualified ESPPs offer that full 15% discount. So if that's your plan, you're buying shares for 85 cents on the dollar relative to wherever the stock is trading. That discount alone is a return that's hard to find anywhere else. And it's why maxing out participation within reason so often makes sense. The second feature is the look back provision, and this is the one people underestimate. A look back lets your purchase price be based on whichever is lower, the stock price at the start of the offering period or the stock price at the end of it. That same 2023 survey found 83% of plans include this feature. Here's why it matters. If the stock happened to be lower 6 months ago than it is today, you get to buy at that lower starting price and then apply your 15% discount on top of it. Combine a strong look back period with a rising stock price over the offering period, and the effective discount can end up well north of 15%. Together, these two features are what separate a genuinely valuable ESPP from a mediocre one. And you don't have to guess which one you have. Both are spelled out in your plan document, usually in a section called purchase price or offering period. If you've ever actually opened that document, if you never actually opened that document, it's worth 10 minutes, because these two terms are the whole ballgame. Here's where a lot of high earners get tripped up, and it's a purely mechanical IRS rule, not a judgment call. Under Section 423 of the tax code, you're capped at accruing the right to purchase $25,000 worth of stock per calendar year for every year an offering period is outstanding. The part that trips people up is how that $25,000 gets measured. It's not based on what you pay, it's not based on what the stock is worth when you sell it later. It's based on the fair market value of the stock on the grant date, the first day of the offering period, before any discount is even applied. So picture this. If the stock is trading at $50 on the day your offering period starts, your plan can't let you accrue more than 500 shares worth of purchase rights in that year. Full stop, regardless of what happens to the price afterward or what discount you're getting. The common outcome here is unused capacity. Someone contributes 10 or 15% of their paycheck, which sounds aggressive, and never gets anywhere near that $25,000 grant date ceiling because their income and their contribution percentage simply don't generate that much purchase volume. For most people, that's fine. But if you're a high earner with a large paycheck, or your company's stock has run up significantly since your offering period started, this is exactly the kind of limit worth checking against your own numbers. Ideally, with your plan administrator's confirmation of the specific grant date value your plan is using. This is the section that actually determines how much of the ESPP gain you keep after taxes, so it deserves the most time. When you eventually sell your ESPP shares, the IRS cares about two dates: your offering date, meaning when the offering period began, and your purchase date, meaning when the shares were actually bought. To get what's called a qualifying disposition, you need to hold the shares for at least 2 years from the offering date and at least 1 year from the purchase date. Both conditions, not just one. If you clear both of those holding periods, the tax treatment is meaningfully better. A portion of your gain, generally tied to the discount you receive, gets taxed as ordinary income, and the rest is taxed as long-term capital gain, which typically carries a lower rate. Sell before you clear both holding periods, and you've triggered what's called a disqualifying disposition. In that case, the discount you receive gets taxed as ordinary income, regardless of what the stock has done since. And any additional gain is capital gain. Short or long term depends on how long you actually held the shares after purchase. Here's the tension nobody puts in writing for you. Holding 2 years to get the better tax treatment means holding a concentrated position in your own employer's stock for 2 full years. That's a real trade-off between a tax benefit and a risk you're carrying the whole time you're waiting for it. One more detail that catches people off guard at tax time. Your W-2 and your 1099-B often won't agree with each other. Your employer typically reports the ordinary income piece on your W-2. Your brokerage's 1099-B often shows your original purchase price at the cost basis, without adjusting for that ordinary income already reported. If you don't manually adjust your cost basis when you file, you can end up paying tax twice on the same dollars of gain. This is one of the most common ESPP filing mistakes, and it's worth confirming with whoever prepares your taxes. Your ESPP enrollment email is going to sell you on the discount. It's not going to walk you through the risk side. So let's do that here. Think about how much of your financial life might already be tied to one employer. Your paycheck comes from them. Your 401k match, if you get one, depends on them staying in business. If you're also receiving RSUs, that's more of the same company sitting in your portfolio. Add ESPP shares accumulating over 6 months, and you can end up with a genuinely concentrated position without ever making a single deliberate decision to build one. This shows up in a specific way here in San Diego. A lot of our biotech and defense sector clients work for companies whose fortunes are tied to the same regional and sector-wide forces, funding cycles, contract awards, FDA decisions. If your neighbors, your peers, and your own equity are all correlated to the same industry swings, that's worth being honest with yourself about. There's also a simpler, more immediate risk: cash flow. Your ESPP contribution comes out of your paycheck after tax, which means it's real money leaving your take-home pay every period, not a theoretical benefit. And if your employment ends, voluntary or not, there's typically a specific, sometimes narrow window in which you need to decide what happens to shares that are already accumulating or already purchased. That's not something you want to be figuring out for the first time during a layoff. None of this means an ESPP is a bad idea. For most people, it's a generally strong benefit. Just means the discount is only half the story. And the other half is worth thinking through before you're 6 months or 2 years into holding a position you didn't fully plan for. So, how do you actually turn all of this into something you can do on autopilot? Instead of redeciding every 6 months, start with your enrollment percentage and set it once, measured against that $25,000 grant date ceiling from Section 3. So you know roughly where your own contribution lands relative to the cap. Then literally write down, a rule for what you do on each purchase date. Something like sell a set portion immediately to manage concentration, hold the rest towards a qualifying disposition, or hold everything for 2 years. The specific rule matters less than having one before the purchase happens, because in the moment, with the stock price moving and confirmation bias whispering in your ear, it's very easy to talk yourself out of a decision you would have made calmly in advance. From there, this needs to sit next to your other numbers, not off on its own. Your 401k deferrals might matter here. For 2026, the elected deferral limit is $24,500, and the combined employee and employer limits under Section 415C is $72,000 per IRS Notice 2025-67. If your ESPP contribution is competing with your paycheck for the same dollars your 401k deferrals need, that's a coordination problem, not two separate decisions. Same with your RSU vesting calendar. If your RSUs vest around the same time your ESP purchases, you may be adding two concentrated positions to your portfolio in the same month. And your withholding needs a look too, because between RSU vest and ESPP dispositions, it's common to end up under withheld without realizing it until the following April. None of this has to be complicated once it's written down. It just has to actually be written down and revisited each time your plan's offering period resets, rather than reinvented from scratch every single time. 3 things to take away. 1, an ESPP is defined by its plan document, not by the general idea of an ESPP. 2, the $25,000 limit is measured at grant date value, which is why so many people leave room on the table. And 3, the tax treatment and the concentration risk pull in opposite directions, which is exactly why this decision belongs in the same conversation as your RSUs, your 401k, and your withholding. If you want to look at your own ESPP alongside the rest of your compensation, that's the kind of thing I do every week with tech, biotech, and defense professionals here in San Diego. You can book a complimentary review by going directly to bas-financial.com. And I'll drop that link in the description as well. We'll pull up your plan document, look at the discount and the look back, look at where your equity sits today, and you'll leave with a clearer picture of whether or not we ever work together. If this was useful, subscribe, because I put one of these out every week or so, and equity compensation for high earners is one of the topics we talk about quite often. Thanks for watching.